This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The application of ethics is extremely important to all professional bodies of accounting, CIMA included. They all take their cue, so to speak, from IFAC, that's the International Federation of Accountants, who have a subcommittee called IESBA, the International Ethics Standard Board of Accountants. And then these ethical guidelines or ethical codes are adopted more or less wholesale by the various professional accountancy bodies. And they apply to CIMA students and to qualified CIMA personnel, whether they're working in industry or whether they're working in professional practice. And the reason ethics is regarded as being so important is that it's really the accountant's ultimate selling proposition. If you're not ethical, why would people pay you good money to produce a report, say, on maybe somebody's cash flow or the viability of a particular idea, if you're not going to do it based really on facts and without being kind of influenced, if you like, by maybe what we'll learn is self-interest. Also, of course, professional bodies, you can be disciplined at any time, you can be thrown out of the professional body if you transgress their rules and regulations and their ethics. And this makes professional bodies like CIMA very different to people who obtain an MBA. Once an MBA is obtained, it's kind of yours for life. There is no particular requirement to carry on continuing professional education or continuing professional development, nor is there likely to be any disciplinary procedures that will cause your MBA to be taken away. The ethical framework, as it's called, recognizes that there are certain fundamental ethical principles, and you will need to know those. These ethical principles are then subject to threats, and what we do is it's really forewarned as forearmed here. If you know that threats can arise in a particular way, then you can maybe avoid that threat entirely, or you can take some sort of mitigating action to reduce the threat to what's known as an acceptable level. It can be quite hard to reduce threats to kind of zero, but if we get them reduced to what's regarded as an acceptable level, that should be okay. So it's what the principles are, recognizing or foreseeing what the threats might be, and then in advance really having some idea what to do, what some kind of safeguards to apply, if you like, to those threats to get them to be reduced sufficiently far. First of all, the fundamental ethical principles that we have here. There is integrity, and you must know the words which are in bold here. There is integrity, and integrity is, of course, honesty, but would also embrace the idea of standing up for your beliefs, not being argued down too easily, not giving in too easily. It would also mean not being frightened to look. So if you see something that looks a bit odd, perhaps in some accounting records, you could of course say, oh well, it's probably kind of nothing, you could kind of always look the other way. That would not be showing integrity. If your suspicion is in some way aroused by something, then you are duty bound, really ethically bound, to follow up those suspicions to see whether they are ill-founded or whether there's actually something there. Objectivity. If you're given a job of work to do, it's important that you look at the facts really and don't be swayed by external kind of influences or conflicts of interest. You're going to give your judgment on maybe a cash flow forecast based on the best estimate you can get and not based on kind of wishing that the cash flow forecast was more optimistic than really it should be. Professional competence and due care. Don't undertake work that you know very little about and aren't going to do very well. Make sure you spend enough time on it. Make sure you stay up to date with new legislations and perhaps new techniques. Confidentiality. Accountants are privileged to see all sorts of confidential information within an industry, within a business. Accountants will often see how the business is doing, kind of 9, 10, 11 weeks, months through the year. And then they will get a very good idea of how the business is going to do for the year. They will have a good idea, therefore, whether the share price will go up or down and so on. You will often see what people's salaries are, what bonuses are, and so on. This information should be held confidentially, unless there is a legal duty or professional right or duty to disclose it, or of course you're given express permission to disclose it. An example of a legal duty to disclose information would be if you suspect someone of money laundering, then the law expects you to report that to the authorities, not perhaps directly, but through some recognized reporting mechanism within your firm. And if there isn't one, then maybe you do have to eventually go to the police and authorities with a suspicion of money laundering. Professional right and duty, maybe if you have to defend yourself in a court of law against some charge of negligence, you are allowed to disclose information that's helpful to your defense. And then there's professional behavior. You have to comply with the law. You have to avoid any action which discredits the profession. You have to be careful of advertising your services. You're not allowed to say that other firms of accountants or other accountants are no good and so on. You have to behave in what you might call a respectable way. So these are the fundamental ethical principles. And then we look to see what sort of threats there might be to this. So what we're going to do is identify the threats, evaluate their significance, see internally whether we can do anything about it, and then maybe if we're still worried about the threat, it hasn't been mitigated internally, maybe we raise it externally, maybe with CIMA, and eventually if the threat is still there, you feel that you are under maybe so much pressure to produce a false and optimistic cash flow forecast for maybe a bank, then maybe the ethical action you take is to remove yourself from the situation. Simply say, no, I'm not going to do that. It's wrong for me to basically tell outrageous lies on this budget. Independence of mind, independence, objectivity, and professional skepticism. Professional skepticism is a bit of a tightrope for accountants to walk. You mustn't be too suspicious of people. You mustn't believe that everyone is out to tell you lies or to pull the wool over your eyes. But nevertheless, you must also be aware that if somebody tells you something, they could be doing it in good faith. But we're all subject to making errors. We can all be subject to optimism, and in a way optimism goes with entrepreneurship. We could tell somebody just kind of quickly and rather carelessly because we're in a hurry. And we, although not assuming everyone's out to commit fraud or to mislead people, we should be aware that part of the human condition is to make errors, to be overly optimistic, to get a bit, maybe a bit fraught sometimes when the right information is not provided. Now, threats arise from these areas. Self-interest. You are encouraged to do something because maybe you get a pay rise or bonus or a promotion. Self-review. We'll see that's basically checking your own work. Familiarity. You become overly friendly, really, or involved with someone, then it's very hard to remain objective, and professional skepticism is kind of eaten away in that one. Advocacy, where you are maybe supporting your employer with the bank, but you overstep the mark. Obviously, we want to support our employers, but advocacy is going out a little bit further than really the evidence would suggest is reasonable. And finally, there can be intimidation. maybe the threat that you won't get that promotion unless you play ball. So self-interest threats. So here you are producing a cash flow forecast on behalf of your employer. This is going to go to the bank. This is going to be used by the bank to extend an overdraft. You own shares in your employer, maybe through some sort of employee bonus scheme. Then of course you are going to be under a little bit of a dilemma. You will want the company to get the loan. Not only do you have shares in it, but of course you're employed by it. And this may encourage you to produce a cash flow forecast which is overly optimistic. The company gets a loan, the company survives, you keep employed, and the share price goes up. Loans and guarantees. A company, your employer gives you a loan. Okay, if your employer is a bank, but what happens if your employer is simply a building company and its main business is not to give you a loan? And then, of course, once it's given you the loan, it can maybe give you a below normal rate. You're beholden to it. They can say, well, if you don't sign off this report, then we'll call in the loan, we'll put up the interest rate and the like. So loans are really only allowed if they're in the normal course of the company's business and on normal arm's length, a normal arm's length transaction. Gifts and hospitality must be within reason. Mustn't be, I often joke that a gift is okay if it's one you don't want. So small gifts, small acts of hospitality, the kind of New Year party or whatever it is that's funded by the employer is probably okay. But once it becomes terribly, terribly lavish, it's going to be kind of almost changing over from just gifts and hospitality into an outright bribe that you might find it difficult to say didn't affect your objectivity or your independence. Contingent rewards or contingent fees. The idea that if you sign this off, then you get a bigger bonus. If you don't sign it off, then you won't get a bonus. Or if you're in public practice, if you sign off this cash flow forecast or this budget or this report on fraud, then you get the job next year as well, or you get bigger fees. If you don't sign it off, then the fees are going to be smaller. Quite obviously, there's a very direct kind of pressure on you coming from self-interest through contingent rewards and fees. Self-review threats. Basically, this is where you check your own work. And we're all quite bad at checking our own work. At least I'm bad at checking my own work. It's boring because you've just done it. But furthermore, it's probably impossible because if you have made an error of principle, you'll probably still make that error of principle when you recheck that work. You need someone independent to do that. Familiarity threats come in because of a close relationship. You become too sympathetic to your employer or to the company, to the person you're dealing with. Family, personal relationships come in here. It could be that your brother is the chief executive officer of the company. You're doing some work for your brother. There's obviously a kind of pressure. You're presumably friends with your brother. You don't want to let your brother down. You may feel difficult to not believe something your brother tells you, and therefore you have your professional skepticism undermined. Personal relationships, just becoming friendly through association over a number of years, working with the same people, you begin to maybe believe what they say without properly questioning it. Advocacy threats, furthering the employer's cause or aggressively without really regard to the reasonableness of it, becoming very partisan, seeing all the good bits and none of the bad bits. So you become an advocate, like an advocate in law, where you're defending something, maybe in the teeth of good evidence against it. Intimidation threats, where you are deterred from acting properly by actual or perceived threats. It could be litigation. Maybe you have been careless about something and they're going to sue you for that. It could be the threat of dismissal, withholding promotion, and so on. Thankfully, it rarely goes down to physical threats, but physical intimidation threats can be covered by this threat to independence. Confidentiality. As I said, you should not disclose information to third parties without the proper and specific authority. As I said, it can be permitted by law or authorized by the client or required by law or professional duty. The obligatory disclosure would be if the client has committed terrorist offences, or there's money laundering, or there's treason. And you have to be aware in some situations, perhaps, that money laundering is a risk, particularly where there's a lot of cash around the place, a cash-based business. It's easy to pump more cash into that business that's really come from, say, drug money, and pass it on off as legitimate sales. Then if you see the cash moving around lots of bank accounts for no good reason, then you begin to be a little bit suspicious. Safeguards which we have can be created by the profession, legislation and regulation, safeguards in the work environment, and safeguards for accountants working in practice. So let's see just some of those there. So safeguards created by the profession, legislation or regulation. Here this is safeguards against some of the threats. Entry requirements, continued professional development, means that people who, say, become CIMA have had good training and they've had to keep it up. They have to adhere and should be trained in professional standards and codes, which gives you a kind of reference point, really, if you're wondering, should I not do this? Professional standards and codes can be immensely useful to help your judgment there. There will, of course, be potentially the chance of punishment, really. There are disciplinary procedures. And, okay, you've got the self-interest threat and maybe one side signing off that slightly optimistic cash flow forecast. Then on the other side is the chance where I could be thrown out of my professional body if I go too far. And then, of course, you can always ring CIMA. They have an ethical support line, an ethics helpline, where you can, really without giving any specific details, you can get some guidance. Safeguards in the work environment. One of the great things is to have proper leadership, which emphasizes ethics, which has itself an ethical code within the business, where there's ethical training and so on. And indeed, where you might be able to whistleblow, where you can go to someone with your problems about maybe someone else's behavior and talk to them about it. It should be made clear that unethical behavior will not be tolerated. It should also be made clear that whistleblowing, justified whistleblowing, will not lead to any sort of punishment. And safeguards for accountants in practice, again, good leadership from the top, good, powerful partners with a lot of integrity and so on. Documenting threats, keeping registers, risk registers and so on. For example, one of the things about accountants in public practice is if a huge proportion of their fees comes from one client, then that client has got a lot of leverage over that firm of accountants. Do what I want, or we'll take our fee away and we'll go somewhere else for this business. And so what you can do is you can document this, you can keep an eye on what level the fees are, and make sure they don't get to a level that you couldn't survive if they went somewhere else. Quality control procedures and reviews. Other people reviewing your work. There are peer reviews right up to the very top in firms that in public practice, where partners review each other's work, not only technically, but to other professional competence and due care is something we have to be sure of, but also maybe looking at the ethical standpoint which is being applied in that. You can get round a lot of the self-review work by having separate teams. So if one team prepares the budgets and another team reviews the budgets, you've got independent minds coming to bear. That will be a way of reducing the self-review threat down to something which might be regarded as being acceptable. And then, of course, disciplinary procedures. The firm should make it clear that breaches of ethics will not be tolerated. What happens if we have an ethical conflict? And this is really what's laid out pretty much by CIMA. Collect the relevant facts. Exactly what is it that's getting at you that you think is going wrong? Compare those facts with the fundamental principles. Is there likely to be a breach of integrity or objectivity or professional competence and due care or confidentiality or professional behaviour? Is it something which is really raising this ethical issue? And see if there are internal procedures, methodology that has maybe been set up to deal with the resolution of these conflicts. You can raise the matter internally first. Go maybe to the audit committee, go maybe to your boss first, then maybe the audit committee, maybe some non-executive directors and so on. Is where to initially raise it. Just because you think there is an ethical conflict doesn't mean there is. You could be wrong, you could be oversensitive. You certainly shouldn't go herring off to newspapers immediately, if ever. Raise the matter externally, in particular obtaining professional advice from relevant professional bodies or maybe from legal advisors. And if it's still not being resolved and you feel you're being pushed into doing something which you're really not comfortable with and which breaches the fundamental ethical principles, then what you should really do is resign. Harder to do than to say, of course, because your salary depends on it. But it might be better resigning than really getting into legal difficulty later if you're found guilty of something. Ethics and control systems in companies. There are two main approaches to this. A compliance-based approach. And this is really where there are really quite detailed procedures set out. And people are signing off quite a lot of kind of documentation there. So if you are looking at awarding a contract to a particular supplier, there'd be some sort of checklist to sign off. Have you looked at 3 suppliers? Is this the cheapest one? Do you have any relationship with this supplier? Are you getting any kind of backhanders from this supplier and so on? Why have you chosen this supplier over other suppliers and the like? So that people, if they're signing this off, really makes them kind of think, am I complying with the rules of this organisation? And if you find somebody hasn't been signing it off correctly, they keep just repeating the orders to the same supplier without going around and getting the best price and so on. Maybe we need a system to report that misconduct, and then maybe there need to be disciplinary procedures. The other approach, and these are not mutually exclusive, is an integrity-based approach, which is where you try to teach people really the difference between right and wrong, between what's acceptable and what's not acceptable as ethical behaviour from a principles-based view. And this is really a matter of corporate culture. It needs quite a bit of training. You'll be sending people on courses where they have little scenarios. They discuss what they think is right or wrong about this. The integrity-based approach is very open-ended. If done properly, it should really be able to handle any ethical dilemma which is there. But of course, you're never absolutely sure that people are applying these integrity-based checks and so on to what's being decided. There's no evidence, maybe, that they've gone through the thought process. The compliance-based approach tends to produce the evidence that we have done our kind of ethical work. But the checklist you're signing off has to be kind of tailor-made for a particular situation. And if there's a new novel situation, there mightn't be a checklist which is yet devised, and people think, oh, there's nothing to fill in, I can kind of do what I want. Maybe what we need is both of these is a kind of pincer approach on ethics. Company ethical codes. Company ethical codes have become quite common. They are even commonly seen now in companies' websites on how they're going to treat really lots and lots of stakeholders. It could be employees, customers, suppliers, the local environment and so on. The government even, in terms of paying its taxes properly and complying with the law. It will guide and regulate employee behaviour. They should be regarded as formal documents. They should really be linked to your contract of employment. If you're going to be employed here, you have to comply with the ethical code, and if you don't, it's grounds for getting rid of you. It should be signed by the employees, really to show that they've read it and are taking it seriously. It will cover a lot of very specific items like receiving entertainment, receiving gifts, and all that kind of stuff going on there that could be influencing you. Be a mix of moral and procedural methods, the integrity-based approach and the procedural methods. It tends to bring down the emphasis on ethics from just being a managerial problem all the way down to the bottom of the company, that everyone can be involved in making unethical decisions. And if the people at the top don't know what the people at the bottom are doing, it can be very hard to trap those. It non-flexible, well, let's expand that a little bit. It should be non-flexible in certain areas. You will not take bribes, you will not accept entertainment, or if you do, then it has to be cleared by your manager and so on. But in some other areas, which are maybe not covered by the ethical code, we need maybe a little bit of flexibility. If this is going to be taken seriously, rather than just a kind of random bit of paper as given out, then it requires management commitment. You have to see that the people at the top, the culture of the organization really, the control environment, if you like, is really enthusiastic about this ethical code. You do have to train people. You may need cultural change, that ethics is more important than just getting the next sale signed up. It needs help, it needs guidance. And I would say it does also need a bit of a stick at the end here. It needs people to know that if you transgress the ethical code, then you will be in trouble.